sponsor the legislation for 5 minutes.
Thank you, Mr. Chairman. My bill, the Corporate Governance Reform and Transparency Act, which I introduced with my good friend from Delaware, Mr. Carney, will foster accountability, transparency, responsiveness, and competition in the proxy advisory firm industry, thereby improving corporate governance and protecting investors. The role of proxy advisory firms in the U.S. economy and in shaping corporate governance is of significant national importance. These firms counsel pension plans, mutual funds, and other institutional investors about how to vote the shares of publicly traded companies that they own. Proxy advisory firms fill an especially important role for institutional investors who have increasingly relied on proxy advisory firms to help them analyze shareholder proposals and carry out their voting responsibilities on key decisions such as mergers and acquisitions, executive compensation, and approval of corporate directors. As the share of institutional investor ownership has grown from roughly 46% in 1987 to 75% today, the volume of proxy votes which investors are responsible for casting has grown into the billions. Last year, a Stanford University study of institutional investors demonstrated that for the average asset manager with $100 billion or more under management, the portfolio managers who make the investment decisions are involved in only 10% of voting decisions, which means a majority of the decisions are made by these proxy advisory firms. Those voting decisions, and in some cases the execution of those votes, have been outsourced and are often effectively controlled by proxy advisory firms like Institutional Shareholder Services, better known as ISS, and Glass Lewis. Last month, the Capital Markets Subcommittee, led by our chairman of the subcommittee, Mr. Garrett, held a hearing on proxy advisory firms, and we heard from witnesses about their history of issuing a one-size-fits-all recommendation. So, for example, Dodd-Frank included a provision which afforded shareholders an opportunity to decide if votes on compensation should occur on a 1, 2, or 3-year frequency, but proxy advisory firms have issued blanket recommendations on a once-a-year vote, which has frustrated congressional intent and shareholder rights. And by the way, has helped proxy advisory firms who now get to offer recommendations every year instead of every 3 years. We also heard about the practice of activist hedge funds offering special compensation schemes for dissident director nominees who would receive large payments if the activist goals were met. And while the SEC has held roundtables and issued staff guidance to address concerns about proxy advisory firms, we heard from former SEC Commissioner Dan Gallagher that the Commission needs specific statutory authority to oversee proxy advisory firms, which is what Mr. Carney's bill and mine offers. It's important because proxy advisory firms aren't immune to conflicts of interest. For example, in addition to providing recommendations to institutional investors about how to vote, proxy advisory firms may advise companies about corporate governance issues, rate companies on corporate governance, help companies improve those ratings, and advise proponents about how to frame proposals to get the most votes. Add to this the inaccuracies sometimes included in the underlying information proxy advisory firms use to issue recommendations. That is why our bill would require each proxy advisory firm to employ an ombudsman to receive complaints about the accuracy of voting information used in making recommendations and resolve those complaints before voting. This is in the interest of the issuers and their shareholders. Let me be clear. My bill is in no way intended to limit access to proxy advisory services. In fact, my bill recognizes the importance of these firms to corporate governance and to the economy. Specifically, my legislation will ensure that proxy advisory firms are registered with the SEC, disclose potential conflicts of interest, maintain a code of ethics, and make publicly available their methodologies for formulating proxy recommendations and analysis. Contrary to claims by opponents that this legislation will make the proxy advisory firm industry weaker, my bill recognizes the duopoly that exists today. Just 2 proxy advisory firms control 97% of the market. It's hard to imagine how you can have a less competitive industry. Now, opponents of our legislation have criticized the private right of action provision in the bill. I've heard that complaint, and after much debate and discussion about this issue, I know that an amendment is going to come from Mr. Foster. I plan on supporting that amendment that would strike that provision. And with that move and an effort to make this more bipartisan, I hope my colleagues across the aisle and on this side of the aisle will support this very common sense bill that supports transparency, accountability, and better corporate governance. With that, I yield back.
Thank you. The